Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of Hong Kong and U.S. tax, what to do if you're a U.S. person and you've got assets, accounts, investments, or income in Hong Kong. Very common. So let's go through the basics, right? If you're a U.S. person, which means you're a U.S. citizen, legal permanent resident, or foreign national who meets the substantial presence test, and you've got assets, accounts, investments, or income in Hong Kong, then you probably have a tax and reporting requirement. It's required for U.S. persons, which means U.S. citizens, legal permanent residents, foreign nationals who meet the substantial presence test, right? So if you've got income, the baseline perspective is even if it was earned in Hong Kong, even if it was tax-free in Hong Kong, chances are it's taxable in the U.S. In addition, all those assets that you have and accounts and investments, they're reportable as well on a whole host of different forms, such as the FBAR, FATCA, PFIC, which we'll get into in a minute. One of the key issues between the U.S. and Hong Kong is that there's no tax treaty. The reason why this is so important, and we'll get to it, like with the MPF, the Provident Fund, with a lot of countries like Australia, the UK, there's a tax treaty, and that tax treaty basically says things like, oh, the pension may not be taxable until it's distributed, who gets to tax what, reduced tax rates, things like that. When it comes to Hong Kong, there is no treaties, similar to Singapore. So in that type of situation, everything is basically default taxable because there's no treaty to rely on to bring that down. Some of the common investment types, Hong Kong, you've got your bank accounts, places like HSBC, Hang Seng, and Citibank. You have investment accounts, mutual funds, and stock accounts. Private limited companies, right? Sometimes they're used for holding companies or coordinated with the BVI. And then you've got the MPF. What makes the MPF so complicated from a U.S. tax perspective is that in Hong Kong, it's basically growing tax-free. There's some tax-deferred benefits similar to a 401k. But since, again, there's no tax treaty, for the most part, here in the U.S., you're going to get taxed on any of the income that it accumulates during the growth phase, where it might be accumulating at a reduced or no tax. From a U.S. tax perspective, you have to pay tax on it. Now, there's not necessarily any specific revenue procedures for the Hong Kong MPF per se, but with the CPF, which is similar over in Singapore, the IRS has stated before that it is taxed, but the contributions made by the employer on behalf of a U.S. person are taxable, and so is the growth. Chances are they're going to say the same thing for the MPF if you try to take the position it's not taxable. But, if that's the position you want to take, that may be a viable position. There are various forms that you have to file when you've got these assets, accounts, or investments in Hong Kong. The FBAR, which is filed directly with FinCEN, Financial Crimes Enforcement Network. It's due on April 15th. It used to be June, in case you see that date anywhere, June 30th, but they changed it to April 15th, and right now it's on automatic extension through October. That could change. You've got the Form 8938. The FBAR, the threshold is $10,000. So if you have more than $10,000 on any given day of the year, an annual aggregate total of all your accounts, not per account, then you have to file the form. 8938 is a little different. It's for assets. It overlaps with the FBAR, but it has its own distinguishing features as well. And whether or not you have to file it will depend on, there's different thresholds. So if you're a U.S. resident versus foreign resident, if you're filing jointly or married filing separate or single, there's different threshold requirements as well. Then it gets into more complicated jargon. You've got your PFICs, which is your passive foreign investment companies, which becomes a common situation when you've got the private limiteds that are being used only to hold investments. Gifts and trusts, depending on if you're getting gifts or trust distributions or gifts. If you have ownership of a foreign trust, you may have to file a Form 3520 or 3520A. And then there might be some entity requirements if you have foreign company in Hong Kong, filing a Form 5471, 8865 if it's a partnership. If you're out of compliance and you want to get into compliance, there's various amnesty programs available. There's the voluntary disclosure program, which is for people who are willful or alternatively just can't certify under penalty of perjury that they're non-willful, something you have to do for streamlined. Then there's the streamlined program, streamlined domestic, streamlined foreign. Both of those programs are for foreign accounts, assets, and investments. It's just streamlined domestic is for non-foreign residents, streamlined foreign is for foreign residents. Then you've got reasonable cause and delinquency alternatives to streamlines. Both have pros and cons. speak with a board certified specialist, get the lay of the land. We have lots of free information available on our main website, goldenlawyers.com. We got lots of sub websites providing information on certain specific aspects like FBAR, expatriation, Form 3520, things like that. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.